I am Kim Hughes, and thank you so much for joining me for the Sane Crypto Podcast, the first cryptocurrency podcast for baby boomers investing for retirement. Most people believe that crypto assets are too risky for the average investor. I believe the risk is in not investing. And in fact, cryptocurrency may be the answer to near retirees' prayers. The trick is to structure our investment so that if the naysayers are right, we don't do irreparable harm to our nest egg. But if the believers are right, we make potentially life-changing money that could catapult us across that retirement finish line. When I talk with baby boomers about the opportunity in crypto assets, a very large percentage will mention the word volatility. Volatility, meaning the variance in price from one day to the next, the wild ups and downs of cryptocurrency, the roller coaster ride. Volatility scares them. In fact, a former client sent me a note that said, "Hey, Kim, I saw you're teaching people how to invest in cryptocurrency now. I don't think my husband would ever let me invest in anything that volatile. Too risky. 3 exclamation points." And this is quite common. So if you said something similar, you're definitely not alone. Most people shy away from volatility, thinking that it is a bad thing. 2 things are happening here. Number 1, your brain is conflating 2 different ideas, volatility and risk. They are not the same thing. And 2, you are allowing an emotional response to keep you from considering what could be a very lucrative and appropriate investment for your portfolio, but you'll never know because you've dismissed it out of hand because volatility is scary. But in fact, volatility in and of itself shouldn't be scary. If you can get past that mental hurdle, it can actually be quite profitable. Warren Buffett's partner, Charlie Munger, says risk to us is 1, the risk of permanent loss of capital, or 2, the risk of inadequate return, end quote. This is the way I've always defined risk as well. Now notice he didn't say volatility. In fact, he has said specifically elsewhere, again quoting, using volatility as a measure of risk is nuts, end quote. Volatility, is just a temporary loss or gain in value. It's not permanent unless or until you sell. And look, preserving capital, while I agree that that is an objective, is completely and totally useless if I average a 4% return over my lifetime, say, but the amount that I managed to accumulate falls so woefully short of being able to replace my income in retirement that I might as well have just lost it playing the craps table in Las Vegas. Because at least that way I had some fun and still ended up in roughly the same place, which is broke. So investing is the art and science of finding that really fine line, that proper balance between risk and return that is most likely to achieve your long-term objective. And in that, you're not worried about the number at the top of your statement today. You only care about the number at the top of your statement at the finish line. That's the only one you can eat. In fact, let's do this. Maybe this will help. Let's look at some numbers. Let's assume that you are 15 years out from retirement and you are replacing a $150,000 per year pre-tax income. Now, if we assume a rate of inflation of 3.5%, which is typical lately, but not historically. If you lived through the 70s, you know what I'm talking about. Okay, but that's what it is now, so we'll go with that. Okay? That means that you are going to be replacing $270,000 per year on an inflation adjusted basis. Okay? Because again, remember you're 15 years out. Okay? So that 150,000 compounded at 3.5% inflation, 15 years, that's $270,000. In other words, it would take that much to keep your standard of living constant. Okay? Now, how close you are to having enough saved to be able to make that number depends a lot on your return assumptions. For example, if I assume 5% return, sort of a blended 60-40 stock and bond portfolio, then I would need to have $2.7 million saved today, 15 years out, to get me to the almost $6 million that it would take to fund my current standard of living at that sort of return. If I assume that I will make 8% on my portfolio for the remainder of my lifetime, which has been the historical rate of return on the US stock market, then I would need to have only 1.2 million saved today to get me there. And if we could somehow find a 12% return over long periods of time, which most people would tell you is hard, if not impossible, in a traditional portfolio, I would only need $500,000 saved today to get me there. And just to put some caveats around these numbers, okay? All of these things are pretty rosy assumptions. Nothing goes wrong. We live in Lake Wobegon where all the children are above average. But they illustrate a point, okay? Most of us will discover when we take an honest look at the math that, like Warren Buffett and Charlie Munger, the devil isn't volatility at all. It's the risk of inadequate return. So what that tells us is that we have to play a perfectly clean game from here on out. No mistakes. And we have to find some extra return. But we can't risk permanent loss of big hunks of our capital either, because we made a bad investment or started chasing returns, or because we made a good investment but were spooked out of it by volatility, those temporary price swings. But fortunately for us, one man's curse is another man's blessing. In The Psychology of Money, Morgan Housel writes, quote, "The problem with viewing crowds as evidence of accuracy when dealing with money is that opportunity is almost always inversely correlated with popularity," end quote. I love volatility precisely because it allows me to pick up extra market return simply for playing a game that others don't want to play, that they shy away from because it scares them or they don't know how to manage it, and I, on the other hand, am quite good at it. In fact, I would argue that's my single biggest strength as an investor. But I wasn't always, to say the least. It was a gradual process over a period of years where I finally realized that in order to profit from volatility and to get that edge that I need, I had to find an ironclad way to keep my lizard brain from making the same emotion-driven mistakes that everyone else is prone to make, because I have the same lizard brain everyone else has, right? So that is to say, buying at tops and selling at bottoms, because that's what lizard brains do. So what I got very good at was developing systems for investing in volatility specifically. And more importantly, I got very good at following the system, no matter how loud my lizard brain screamed at me that we're all going to die. And this has been the key to my success as an investor, and I would add in my clients' success over the last 20 years of my career, which puts me in some pretty lofty company. Warren Buffett and Charlie Munger, who I mentioned earlier, also invest based on a system that they have built and followed for a lot longer than I have. Their system is designed around value investing. Mine is designed around volatility, but the idea is the same. Again, quoting from The Psychology of Money, Housel writes, quote, "There are over 2,000 books picking apart how Warren Buffett built his fortune, but none are called, 'This guy's been investing consistently for 3/4 of a century.' But we know that's the key to the majority of his success. It's just hard to wrap your head around that math because it's not intuitive. There are books on economic cycles, trading strategies, and sector bets. But the most powerful and important book should be called 'Shut Up and Wait.'" End quote. That system of Warren Buffett's allowed him to buy banks at the bottom of the financial crisis when no one else had the nerve, no one else would touch them. Billions and billions and billions of dollars of banks on fire sale. And conversely, for better or worse, pass on technology companies because they don't fit with his system. He never reacts emotionally, he never flinches, and he never chases shiny objects. Most people think that the market's job is to make them money. And that's just incorrect. The market's job is to make less than half the people money. And that's because the market is not just zero sum, where I win $1, you lose $1, but it's actually a negative sum game when you factor in the vig that Wall Street takes off the top. So there's an old saying in poker. If after 10 minutes at the poker table you don't know who the patsy is, you're the patsy. If you aren't making at least the market average, you are the loser. And the market produces more losers than winners, statistically. So I love volatility precisely because you hate it. And it scares you, and it makes you do dumb things. That is how I win. On the other hand, when you know how to play the volatility, you can go after those higher returns without being the sure patsy. And higher returns means not guaranteed, not certain, but at least much higher probability of reaching your goals. And most of us need all the help we can get. So as always, I hope you found that helpful, something for you to consider. If it was helpful, you could do me a great big favor in return. If you've enjoyed this and the other episodes of this podcast, please go to iTunes or wherever you get your podcasts and subscribe so you don't miss a single episode. And 2, this is the big one, go to iTunes and leave us a 5-star rating and a review with comments and feedback so more people like you can find us and share the love. If you'd like to learn more from me and about my system for investing in crypto assets for retirement, note the keyword there, system, hint, hint, then you should, I would really encourage you to register for my free online training, which is called How a Little Bit of Bitcoin Can Make Your Retirement Savings Go a Lot Further. You can do that at sanecrypto.com/retirement. And finally, you can get the full show notes of this episode at sanecrypto.com/podcast, including links to books and the various resources that I mentioned and quoted from, including a dozen things I've learned from Charlie Munger about risk by Trent Griffin, which I've quoted from extensively and highly recommend. The Psychology of Money is there as well. Really good stuff. Again, the free online training is at sanecrypto.com/retirement, and the show notes are at sanecrypto.com/podcast. And finally, if you have a question, comment, thought, debate about today's topic or anything else, just email me at askkim@sanecrypto.com. I read and answer every email personally. It may not be that minute, but I will get back to you, as well as answer some of them here on the show. So I really appreciate those. Everything I say on this show is for educational purposes only. Nothing should be considered investment advice. Past performance is no guarantee of future results. All investments involve risk, so do not, under any circumstances, invest money you can't afford to lose. All right, y'all, that's it for me. I'm Kim Hughes. I'll be back next week. And until then, may the crypto gods continue to smile on us all.